Welcome to this bite-sized webinar. My name is Tasha Fry and I'm a consultant at Johnson Fleming who are employee benefits specialists. It's likely we work with your current employer, which is why you've received the link to today's session. Now, I won't keep you long. This session is designed to give you a bite-sized, high-level introduction, helping you start your journey towards managing your financial wellness. In this session, we're going to look at how to write a financial plan. Whether you're putting money aside today already or before you start to do so, it's important you work out exactly what it's for. We plan for things every day, consciously or not. For example, every time you get in your car, you'll have thought about your destination, the planned route you want to take, for example, which road you're going to drive, and you'll also have an idea of how long it's going to take to arrive. Not forgetting any unforeseen events, for example, diversions, roadworks, or even a breakdown. Now, whilst you might well do this subconsciously, it shows the sort of planning you likely do every day when we're not currently in lockdown. And we drive around and take these choices as part of our everyday approaches. Now, this goal setting also needs to be applied to your savings. Setting clear goals will help you to know your destination, stay on track for your planned route, ensure that your money is in the right place for its intended use. All of this can lead to helping you achieve your goals. We've mentioned there might be some unforeseen circumstances along the way, bumps in the road if you like, and these will require you to review and perhaps amend your goals. It's important to know this and be flexible. You might need to adjust or redistribute your savings. Then you need to make sure you take time to review and monitor a revised plan. Now, in order to start all of this, you'll need to understand your current financial position today. You should take steps to make this as robust and effective as you can. Recent research has shown that people who set a goal not only save faster, but also up to £550 a year more than people who don't. So before you even consider what sort of interest rates you could make, there's an additional amount right there of over £500 you could achieve just by some simple goal planning. Now, you've probably come across this acronym before, and it does really work. When setting goals and objectives, it's important to make them smart. S stands for specific. As I've mentioned, make sure you have something in mind for the money. Measurable, how will you know when you've reached your goal? Is it a happy retirement, living in the house that you've always wanted, in the sort of price bracket that you've aspired towards? Is the goal achievable? Can you do it? Do you need more help or perhaps more time? As well as achievable, is it realistic? Have you looked at the sort of interest you can make, or do you even have the sort of disposable income available to start saving at those levels in the first place? And T stands for timely. Put a number on it. This could be months or even years. So decide what you're saving for and write it down. Is it emergency savings? Is it peace of mind in the form of financial security, perhaps reducing current levels of debt? Is it buying a house, perhaps your first home or a new home? Is it starting or extending a family? Or is it retirement, which could be close or a long way away? Now, planning can be complex, as some or all of these things might be on your list, and the list could also be endless. You'll need to consider things like buying a car, going on holiday, and perhaps saving for your children. Now, these goals also often run alongside each other. Short-term goals, such as this summer's holiday, which might well have now been delayed, that could run along longer-term plans like retirement. You'll need to review your budget and decide how much you have available to save towards your goals and allocate the funds accordingly. It often helps to do this automatically using standard orders on online banking, perhaps shortly after you're paid your monthly wage. Now, our next bite-sized session looks at this in more detail. So right now, your goals might not agree with the funds that you have, But every little helps, and it's important to start putting aside what you can as soon as you can in order to start building your financial resilience, which is basically creating a financial buffer. The recent COVID-19 events have shown how important having this safety net can be. So how do you prioritise? We think the simplest way is to consider your short, medium and long-term goals. Your first priority should be to create short-term savings and plan for emergencies. These are those things that life likes to throw at you, from new car tyres, washing machine breakdowns, to more serious events like redundancy, illness or accidents. Now, you might have insurances in place that could cover some or all of these things, for example, income protection, which could be offered by your employer. However, the general guidance is that you should aim to have 3 months' worth of living expenses saved for these emergency situations. Another short-term plan could be to reduce expensive debt. Consider how much you've got borrowed and what you're paying for that debt. Things like payday loans, credit cards, bank loans, car finance. Write down how much is outstanding and when it will be paid off. Could you make a plan to pay back some early, reducing the cost of debt? A good way to compile all of this information is by running a free credit check with a scoring company. This will give you a financial credit report showing all of your current balances. These first 2 points will be the cornerstones to creating your financial resilience. It might feel daunting initially, but start to save what you can. Recent research found 500,000 households would be protected from problem debt if they had just £1,000 in savings. This shows it shouldn't be ignored and should be a priority for all of us. Again, with COVID-19, it shows us how suddenly financial shocks can be thrown at us. Without this buffer, you'll be more vulnerable to the smallest change throwing your plans off track, and this makes it more difficult to achieve your goals. The more financially resilient you can make yourself, the more achievable your goals will become. For the short to mid-term, your goals might be saving for a house deposit. Find out how much you could borrow for a mortgage and how much deposit is required, and you can start this research at any time. You could do it online or with a mortgage advisor, and you don't have to wait until you're in a position to make the purchase. This can help you plan. Perhaps you're planning to start or extend a family. Think about the cost of parental leave. Statutory government pay pays 90% of your regular earnings for the first 6 weeks, but then for the remainder, you're paid roughly £150 a week. So unless your employer offers enhanced pay, this could be significantly less than you're accustomed to earning. Also spare a thought for the additional £4,306 a year, which is the annual cost of raising a child, according to a 2018 report. For the longer term, how much income will you need in retirement? What will you be paying for when you reach retirement? And how much will you need to fund those years that you've been working for? This will largely depend on your ambitions, but generally no one wants to reduce their standard of living once they finish work. For most people, this means achieving an income of 1/2 to 2/3 of the wages you received whilst working. Saving for your children or their future. Do you want to privately educate your children or perhaps pay for them to go through university? It might be buying their first car or helping them get on the property ladder. Really evaluate your priorities. And remember, it's going to be far easier to prioritise saving for things that you feel good about today, for example, upcoming holidays or a new car. But just remember to look forward a few years or even to retirement and debate whether you need those things now more than your future goals. Any financial planning, whether you do it alone or with an advisor, will provide the building blocks to allow things to continue when life happens. So now that you know what you're saving for and how much you're aiming to save, you need to decide where to put your money so that it works as hard as it can for you. In our next session, we're going to focus on finding ways to find more money to save by taking small steps to reduce your outgoings. But where you should put this money will depend on how much time you've got to reach your goal and how much risk you're willing to take. You'll also need to think about inflation, which is the rising cost of living. £100 saved today would not have the same buying power in 10 years' time unless it achieves growth of at least inflation. This alone can help you determine the sort of investment returns you might need to target by looking at how long a time span you have and how much inflation you might need to effectively beat. Remember to shop around and look at the savings rates, charges, and potential investment returns that are available. For short-term goals, things like emergency savings, buying a house, starting a family, you're probably looking to save for no longer than 5 years. So you'll probably want to save into an account that is accessible and doesn't expose your money to risk. So this can be things like savings accounts, perhaps attached to your current account, or a cash ISA, which might well again be offered through your current bank. If your goals are a little further away, perhaps 5 to 10 years in the future, you could still use a savings product, but perhaps one that restricts access for a number of years. Or you might consider using investments if you feel comfortable exposing your money to some investment risk, so a stocks and shares ISA, for example. For saving goals that might feel a lifetime away, so retirement for most people, consider investments like pensions. These allow you to invest in assets more than cash, and they can achieve growth that can certainly outstrip inflation. Once you know where you are saving, set up a standing order so that savings are removed from your account as early as possible. So perhaps the first of the month if that's when you're paid. As with all finances, don't get complacent. Much like doing your car insurance each year, make sure you review your savings. Consider, are your savings goals still the same? Have your circumstances or priorities changed? Are you still on track to meet these goals? Have you met them so far? Are you saving the amount you hope to? Have you been saving less? Do you need to reevaluate why? Or do you need to change your savings expectations? Perhaps lower, or could you save more? Now, to help you, here's a template of a really simple financial plan that we've created. We've made this a PDF so that you'll be able to print and hopefully use it, and do contact us if you'd like a copy. So this really brings us to the end of the first session. I say the first as it's a series of bite-sized sessions, and we really hope that you found this one useful and will join us in future sessions. We'd certainly really welcome any feedback you might have, and if you have any questions at all, please do send us an email and you'll see details on the screen. Johnson Fleming specialists in employee benefits and guidance and education. But if you do feel you would benefit from full financial advice, you can certainly find your own independent financial advisor at unbiased.co.uk, or we'd be pleased to make a referral for you to our sister company, Johnson Fleming Future Life Planning. Thank you for listening, and hopefully join us again soon.